last quarter was by far the biggest miss we've had since I've been doing this. Q4 2019, I think, was actually the first time I did it, and yeah, it's been very accurate historically, with pretty much just the one exception last quarter.
Yeah.
So I'll kind of walk through the changes. The way I like to think about this and to kind of explain it is, what are the changes from what was reported in Q3, or essentially what I'm calculating from Q3 to what I'm projecting from Q4. So I've gone back through the historical periods and tied out what my assumptions in the model should have been in order to match the results which Tesla actually posted. So starting with price here, the big change is I'm actually assuming a price increase from Q3 to Q4 for the Model 3 and the Model Y. It's almost $1,000. It's about $900. It is $900
So
of
in
a price increase.
Q3, you had 53,763 is the average price for Model 3 and Y, right?
Yep. So in Q4 now, I'm showing 54,663. So that struck me as very strange, actually. So I want to walk through like what's the rationale for that. So we have this other kind of detailed buildup. I think we walked through this last quarter of kind of the profitability and ASP by plant. We're not going to walk through all this because it takes a lot of time and it's a lot of math. But essentially, you had price cuts most significantly in China. And then at the end of December, you had some extra price cuts in the U.S. as well. So I kind of assumed a weighted average price cut for both of those markets, and so I was assuming that the ASP would decrease. But what the answers actually showed when I ran the math was that the higher weighting of or the higher mix shift of deliveries to Europe actually resulted in
from Shanghai,
but also in Berlin. In Q3, 15% of the deliveries were going to Europe. I'm estimating 24% of the deliveries went to Europe in Q4. So you've got a pretty significant mix shift to Q4, which apparently outweighs the ASP cuts in China and in the US.
One quick note is that 15 to 24% is not on the same number. It's on a higher number, right?
Yeah.
From Q3 to Q4 too. So deliveries in Q3 was what, like 340 or something, and then 405.
Yeah, 340.
Yeah. So it's not just 15% of 340 to 24% of 340. It's 15% of 340 to 24% of 405 going to Europe, right?
Yeah.
So it's a big change.
So the European cars obviously have a much higher ASP than the Chinese, and so that's what's driving that slight increase. So that was a bit of a surprise, but that's what's driving this assumption here. It's not just a ridiculously bullish assumption. So kind of going through here, just took the deliveries from the production and delivery report, plugged them in, nothing too exciting. I assume 30 semi deliveries. It really is rounding error. It doesn't move the needle at all, but that's why there's this slight disconnect between what was reported in the P&D report and what's shown here in this model. So there's a bit more math down here. I won't walk through every line, but I'm assuming a slight decrease in FSD take rate, just as you get, I think, the economy slowing a bit, and a significant portion of sales in Europe and China, which have a lower take rate than the U.S. I'm just assuming. I think it's a reasonably safe assumption, or at least conservative assumption, to assume a slight decrease there. So in Q3, I assumed 7% take rate across the entire delivery total. I'm assuming that drops to 6% in Q4.
And that's just global, so it might be like 10 or 12% in the U.S., but like 3% in Europe, 1% in China, or something like that. So averages to 7, right?
Exactly. Yep. So we've got a couple other small things which aren't too impactful here, but I'm calculating out acceleration boost, FSD subscriptions, and EAP. EAP is so enhanced autopilot. That's actually I think they introduced that right at the end of Q2, and so it hasn't really had a whole lot of time to make an impact on the financials, and they haven't really disclosed any information on take rate on that. But it's such a compelling offering. It wouldn't surprise me if the actual take rate on that is higher than what I've modeled here. Only 31,000 subscriptions overall, and then I'm assuming 49,000 FSD subscriptions overall. I mean, and keep in mind, these are kind of cumulative figures that should be growing over time, especially as the functionality improves. So it's just, when you think about the optionality of Tesla and having these like pure margin software upgrades that they can sell at any time, it's one of the reasons I get so excited about Tesla, because it could just be like one random quarter they disclose, oh yeah, like we had amazing margins because we have 400,000 FSD subscriptions or something crazy like
Yeah.
that.
Yeah.
And it'd be like, okay, everyone's got to redo their models now because nobody was really taking into account any meaningful take rate on those. So anyways, I calculate the pure auto revenue, which is essentially just the ASPs times the deliveries. And then I'm calculating a take rate on FSD. And then here is another kind of big assumption for Q4. We know that the vast majority, well, not the vast majority, but historically around 50% of FSD take rate has been deferred. I think it's actually a little bit higher than that based on some numbers digging that I've done. So I've assumed it was 42% for the last many quarters of all FSD revenue is classified as deferred, which means that your deferred revenue liability on the balance sheet is actually, grows over time. But I think with what they shipped out in Q4, they're likely, in my mind, going to be able to qualify to recognize a good chunk of at least the US and Canadian full self-driving deferred revenue. So I'm assuming this percent of FSD revenue, which is classified as deferred, will drop from 42% to 25%. And what
And again,
that
this is
does
global, not just the US, because like Europe
yeah,
and Asia, it'll still be close to like 100% or something, but in US, it might
yeah.
drop to like 10% or something. You're thinking, or
So they only have, or they have around $2 billion of a deferred uh, liability, deferred revenue liability, which is attributable to FSD. We don't know the exact number because they lump it in with all these other things like free
yeah.
supercharging and other things that are in that line. So you've got to kind of make some estimates. But I'm assuming about $1.9 billion of deferred FSD revenue at the end of Q3, and then with this big chunk of recognition for the U.S. market, I'm assuming that $800 million of that will be recognized in Q4. So that's going to be, I think, a headline number if this comes to pass in Q4, where a lot of people will be like, oh, I think it's going to be mostly a negative, to be honest with you, because it seems to be always the way it is. It's like, oh, like Tesla would be profitable if it wasn't for credits. I think you're going to have a similar sort of thing here. It's like, oh, they had $1
Yeah.
billion of credit and FSD revenue. And so
Yeah.
they're like juicing their margin numbers or something like that.
Yeah.
So
I could see
I,
that.
I think analysts will back it out, and that's probably the correct thing to do. But then you're going to have higher profitability going forward because you can
Yes.
recognize more of the revenue. So that's an important thing to keep in mind. Like if for example, and I don't mean to harp on this for so long, but if they could have fully recognized all this revenue all along, then they'd have an extra $2 billion of earnings over the past several years. So it's like it's actually kind of artificially depressing their historical financials. So you can't both like ignore it historically and ignore it going forward. Like that just
Yeah.
doesn't make any sense. So you've got to, if you're going to ignore it historically, then you've got to account for it going forward
And
to be a more meaningful driver.
one thing to look at it going forward is, if it gets recognized fully at the point of sale going forward, as opposed to half of it being deferred or whatever, then that improves margins to a degree that might offset some significant amount of the price cuts. So maybe the gross
Yeah.
margins, because of those two things happening to offset each other, won't be as drastic as people fear.
Yeah. Oh, absolutely. I mean, we try to model things conservatively. We're not showing the 2023 projections that we have in here right now. But we are using pretty conservative assumptions around that. But if it does actually start to move the other way and take rate starts increasing, then yeah, that can have an incredibly material impact on overall gross margins. So some of the other assumptions, I'm assuming $300 million of credit revenue, which is pretty in line with where they've been the last couple quarters. Q1 was kind of an anomaly. They were at 679 million, but after that it was 350 and then 286 million. So I think 300 seems like a reasonably safe bet. But again, it would not
It's
surprise me
conservative.
if this
Yeah.
came in at 500
500
million or
million. Yeah.
700 or something like that. So yeah,
Yeah.
trying to be conservative. We don't want to assume some huge EPS benefit from a anomalously high credit number. So anyways, adding all that together and then adding in the lease revenue, which I've calculated separately, you get to total automotive revenue of $23 billion. And then adding in energy and services. So energy in particular, I'm assuming is going to grow pretty substantially. I'm assuming $500 million of incremental energy revenue, just related to the ramp of of mega packs. So there's been a lot of deployments that you guys like Zero Sum Game and others have been bringing attention to this. And so I'm assuming that will start to ramp, although it's still going to be well below the kind of 10 gigawatt hour quarterly run rate that the Tesla is theoretically capable of. So that's driving the kind of significant quarter over quarter top line increase there. So putting that together, the core manufacturing margin. So this is another assumption that's really integral to the way that I do this model. So essentially, what I'm trying to do on this other tab over here that we're not going to go into is not only building up the ASP by region, but also building up the cost of goods sold by region and by delivery. So both where is the vehicle manufactured, and then to which market is it selling. We know Martin has said that the Model Y is made in Europe, made in
China.
Shanghai, and shipped to Europe are the highest margin. So we've done a lot of kind of back calculations and estimating of how the different cost of goods sold will build up, and then how the ASPs trend, and kind of checking those against historical financial reports and making assumptions that tie out to those. So when we went through that exercise for this quarter, we showed that you had a roughly 1% increase in the core manufacturing margin. And that is aided a little bit. I think about half the increase is just with a foreign currency effect. So we were coming up with a range. If you completely excluded foreign currency, we were looking at about 0.5% of improved core manufacturing margin. The foreign currency benefit that we calculated was around 1% gross margin benefit. So we kind of just took half the assumed or half the calculated benefit and assumed 0.5% from kind of mix shift and continued efficiencies, and then 0.5% from currency translation. So putting those together, you get a 1% quarter over quarter improvement to 25.2. So then that gets you to the kind of core manufacturing gross margin. Then you add in the full self-driving and other acceleration boosts and all those, and then the credits to get to $7 billion, almost $7.1 billion of auto gross margin. Now keep in mind, 800 million of that is the assumption around deferred revenue recognition, and that gets to automotive gross margin of 30.7%. But again, this is significantly elevated due to the deferred FSD revenue recognition.
Without that 800 million. Without that 800 million, then the automotive gross margin might have been closer to in line with last quarter, or even less, right?
Yeah. So let's just check that here. So it'd be 28.1. 28.1.
Okay, so
it'd be a modest increase quarter over quarter.
Yeah, just barely above it. Okay. So it'll look juiced because of the $800 million deferred revenue.
Yeah, it's like a 3% benefit there.
Yeah.
So then on energy gross margin, I'm assuming that's going to increase again. So in Q2, it was 11.2%. It dropped in Q3 to 9.3%, which was a little surprising. It looked like they had some pricing issues with their stationary storage. But I'm assuming with a little bit of a higher scale and potentially some higher priced mega pack contracts being realized in Q4, that this would increase just marginally from 9.3% to 12%. So that gets to $227 million of energy gross margin. So this is a somewhat meaningful. It's creeping up. I mean, that's not going to move the needle for the quarter very much, but it's the sort of thing that would catch people's notice if you had gross margins from energy essentially double quarter over quarter. That would definitely catch some attention. So this is something I could definitely be wrong either way on this assumption. I think it could be higher or lower than this. But it does make sense that this is going to start to be a little bit more material.
What quarter do you think they'll have over $1 billion in energy gross profit? Do you think it'll be this year sometime, 2023 sometime?
Well, it's
all the ramp of the mega pack. Just if you just spitball, what do you think? I think
50,
you think it'll be Q4 next year
sometime.
So if they
do 10, I'm just going to do the quick mental math. So if they're Q4 next year, let's just assume they're at 10 gigawatt hours, which is the quarterly capacity of Lathrop. So if they get to 10 at $500 per kilowatt hour, that'd be $5 billion of revenue. So at a 25% gross margin, they'd be just over $1 billion. So yeah, I think Q4-ish. Some of it depends on deferred revenue or revenue recognition. Sorry, not deferred revenue. But I think Q4-ish seems like a decent time where they could be pretty close to $1 billion of gross margin.
That'll be fascinating. I think that'll be really get people's eye when that starts happening. I think.
Yeah, I mean that's a 10x from where we were just last quarter. So I
Yeah.
mean this is where it gets hard because you don't have a whole lot of history to rely on, but
Yeah.
the math, like if you when you start doing the actual work of making these assumptions and trying to make them reasonable and not just super optimistic, I think even then
Yeah.
you're getting numbers just that you need to that would make Wall Street take notice. I
Yeah.
know you're a little bit more pessimistic on that than I am, but I mean, what do you think? Does a billion a year from now sound too crazy to you?
Yeah, it does. I'd say 2 years from now. 2 years
All
from
right,
now is my conservative guess. Maybe 18 months is like my 50-50 mark. Yeah.
and I could see that. I mean, that wouldn't. I think that certainly could be the case. So,
Yeah.
and I don't want
But
to
still, I mean, that's
get
great.
everyone's
But
hopes up.
Tesla, it's $1 trillion market cap valuation. It's got to get back to that. You'd think around that time or by then, and you got to get to the billion plus of gross profit on this new kind of business on the energy business to really, I think, take notice on $1 trillion market cap company. Like if it's a $200 billion market cap company, oh, that's huge, right? But for $1 trillion market cap company, you got to have an extra zero or two to make it really substantial for the valuation, in my opinion.
Yeah. Or more than one product line. I mean, this is
Yeah.
almost everybody still just views Tesla as an automotive company. And so if they
Yep.
say, hey, you know what, they've actually got this really
Yeah.
meaningful, growing and profitable business line, which has a backlog of many years and they're ramping
Yeah.
capacity. So we got to do that work and model it now. And then, oh shoot,
Yeah.
yeah, it looks like it's going to be $1 of earnings per share. So we need to apply a multiple on that. And so then that gets you to a more significant
Yeah.
valuation. So yeah, I agree with you. It's something will I think this can really boost the kind of long-term growth prospects, and it also
For
diversifies the
sure.
revenue streams, which is helpful in a recession.
Yeah.
Um, all right, so I'll kind of zoom down the rest of this. It's less impactful assumptions going forward, but you can see the total gross margin. So energy services. Oh, actually, sorry, I skipped services. So services margin, I actually dropped down to zero. So historically, this has
Hmm.
been negative, but the last couple quarters, it's been positive around 4%. And the reason for that, I believe, we talked about this for the last couple quarters, is that Tesla was getting the Model 3 leases
Leases.
from
Yeah.
2019 off lease, and they had the right to sell those. So with used vehicle prices being as high as they were earlier this year, or earlier in 2022, Tesla was seeing a pretty significant gain on those vehicles. We believe, anyways. They don't disclose the details around that. But they've got all these an increasing number of Model 3s coming off of lease every quarter as we get kind of like 2019 Q2, I think was the first time they had this. And then so you could remember that ramp. So then in 2019 Q3, they had even more vehicles delivered and going on lease. And same thing in Q4 of 2019. So you're going to have more and more of these Model 3s coming off lease. But the used car prices have been hit pretty hard. So I'm assuming that the kind of benefit that we have been seeing for the last 2 quarters of the leases gets reversed away a bit in Q4. So I assumed essentially that this whole margin line is break even for services, and this assumes more than just used car sales. There's
Yeah. And sort of
the
de minimis
supercars and all this
anyway,
stuff.
right? Whether
Yeah,
it's 0 or 5%, it's like, less than $10 million for the bottom line, sort of de minimis, right? I
yeah.
mean,
I mean, if
okay.
they doubled quarter over quarter their gross margin and got to 8%, it's 150 million. So
Oh,
that's like kind of
150.
nice.
Okay. Yeah,
It's
that would
kind of
be
nice,
really
but
nice.
it's not.
Yeah, yeah, yeah.
But
But it's
like
not
even
gonna.
then, it's like rounding error of the automotive gross margin. So
Yeah. Yeah. Yeah.
this could move either way, I think, but I
Okay.
think it's reasonable to assume declining prices lowers the overall profitability of that part of the
Okay.
business.
Okay.
So then I'm assuming just modest growth in these operating costs. I don't want to walk through those, and then some slight changes on, or not slight changes. There's all this kind of below the line stuff, which is not super impactful.
Mhm.
But essentially, we're getting to $5 billion of net income, or $1.45 of GAAP earnings per share.
Scroll down a little
Um,
further because our pictures
oh,
are in the
sorry.
way. Okay, there we go. Yeah.
Yep. So $1.45 of GAAP earnings per share. But remember, Wall Street is absolutely going to back out the deferred revenue. And this is something that's a little bit interesting. So I backed it out. I backed out that deferred FSD revenue recognition in Q4. So the kind of reported non-GAAP adjusted earnings per share figure that I'm calculating here is $1.34. The street right now is at $1.10. So this is a somewhat sizable beat. It's not like a massive blowout we're projecting here or anything like that. But I think this would certainly be good news if Tesla was able to deliver results like this.
Yeah.
But I'm kind of curious to see what Tesla does if they actually do recognize this revenue, because they have recognized chunks of like $60 million or $80 million of deferred revenue along the way. I think 2021 was the last time they recognized some of that, and they did not back it out of adjusted earnings per share. So
Yeah.
I wonder if they recognize $800 million, would they also not adjust it out? I'm not sure, but I know Wall Street would, even if Tesla reports it. So Tesla may actually report like $1.45 of gap and then just back out the stock-based compensation. And so that they could report
The stock-based
adjusted
compensation
earnings
is
per
like
share.
the stock-based compensation is 10 cents the other way, and then the
Yeah,
deferred revenue is like 21 cents. So that's why you have a net 11 cents or something, right? Credit.
exactly.
So it goes down to
Exactly.
$1.34. Okay.
Yep. Yep. So, but like if Tesla just stuck to the way that they used to do it when the deferred revenue was a smaller amount, they could actually report adjusted earnings per share of $1.55 if all they
Mm,
do is add back the stock-based comp. But my
yeah.
point is, Wall Street will adjust the adjusted earnings per share, and so the real important numbers is like $1.34. So that's kind of
Mhm.
what I'm looking for. If they've got some like ridiculously high adjusted EPS, and that's the first thing I noticed. Like my first the first place I'm going to go is, all right, did they back out deferred revenue recognition?
Mhm.
So a little bit of kind of
$1.34.
finance
Okay.
nerdy stuff, but $1.34, yeah, that's what I'm assuming here.
Okay. Cool.